Welcome back to our deep dive into the property and casualty insurance industry. In our last breakdown, we discovered that insurance is actually a massive capital gathering machine powered by float. We learned that the ultimate goal is to hold other people's money for as long as possible without paying interest. But to understand how companies actually achieve this, we need to talk about the difference between a fender bender and a massive corporate lawsuit. In the insurance industry, this is known as the difference between a short tail policy and a long tail policy. The length of the tail determines everything. A short tail line of business, like standard personal auto insurance or basic homeowners insurance, is incredibly predictable. If you back your car into a telephone pole, you are going to call your insurance company that exact same week. The claim is reported quickly, the adjuster assesses the damage quickly, and the check is written in a matter of months. The insurance company holds the premium for a very short amount of time before paying it out. Because the timeline is so compressed, there is very little uncertainty. The company knows exactly how much the repairs cost based on current market prices. But commercial casualty insurance is a completely different beast. Imagine a company selling complex liability coverage to a chemical manufacturer or a massive construction firm. If a worker gets sick or a building's foundation cracks, the actual lawsuit might not be filed for 5, 10, or even 20 years after the insurance policy was originally sold. This is a long tail line of business. For the insurance company, the long tail is a massive opportunity because they get to hold and invest the premium dollars for decades before ever writing a check. That is how massive float is generated. However, the long tail is also where insurance companies go to die. When you are estimating the cost of a lawsuit that will not be settled until the year 2035, you are making a massive gamble on the future. You have to predict medical inflation, the rising cost of legal fees, and the unpredictable nature of jury verdicts decades in advance. If your actuaries guess wrong, the compounding effect of that mistake will slowly eat your company alive from the inside out. Which brings us to the most dangerous accounting trick in the entire financial world. That dangerous accounting trick is called under-reserving, and it is the absolute fastest way for a dishonest insurance executive to fake massive profits today while destroying the company tomorrow. To understand how this trap works, you have to look at the balance sheet. When a company writes a long-tail casualty policy, they know they will eventually have to pay out claims, but they do not know the exact amount yet. So they are required to set aside a massive pile of money called a loss reserve. This reserve is a massive liability on the balance sheet. Because many of these claims have not even happened yet, the company has to calculate a specific number called incurred but not reported, or IBNR. This number is quite literally just an educated guess made by the company's actuaries. And because it is just a guess, insurance accounting is uniquely malleable. Here is exactly how the trap snaps shut. Imagine a company is having a bad year. Wall Street is demanding higher earnings and the stock price is dropping. The chief executive officer can simply walk into the actuarial department and tell them to use slightly more optimistic assumptions about the future. By lowering the estimated cost of future claims by just a few percentage points, the company can instantly release hundreds of millions of dollars from their reserves straight into their current year earnings. On paper, the company suddenly looks incredibly profitable. The combined ratio drops, the stock price skyrockets, and the executives cash out massive performance bonuses. But the actual risk did not disappear, it was just hidden. 5 or 10 years later, those complex lawsuits finally start going to court. The actual cost of the settlements comes in drastically higher than the optimistic guesses. The executives who faked the numbers have already left the company, and the new management team is forced to announce a massive adverse reserve development charge. Overnight, billions of dollars of shareholder equity are completely wiped out to cover the shortfall. This happens constantly in the commercial insurance industry. The best investors know that you never trust a casualty insurer's earnings until the claims are fully paid. But even if a company survives the reserve trap, there is an invisible ceiling that prevents them from growing forever. That invisible ceiling is called statutory capital,
And it is the strict regulatory limit that dictates exactly how fast an insurance company is legally allowed to grow. You might think that if an insurance company has a brilliant management team and a fantastic combined ratio, they should just write as many policies as humanly possible to gather an infinite amount of float. But they cannot do that. The insurance industry is heavily regulated by state governments, and regulators do not care about shareholder returns or float generation. Regulators only care about one thing: making absolutely sure that the company has enough cash on hand to pay the policyholders when a catastrophe strikes. To enforce this safety net, regulators monitor a metric called the premium-to-surplus ratio. Think of surplus as the company's ultimate emergency fund. It is the net worth of the insurance company after all liabilities and reserves have been fully accounted for. As a general rule of thumb, regulators will not allow a property and casualty insurer to write more than $3 of premium for every $1 of surplus capital they hold. This 3-to-1 ratio acts as an absolute speed limit on the business. If a successful insurer wants to grow their market share and write more policies, they must increase their surplus capital first. They can only do this in two ways. The first way is the hard way. They have to consistently generate pure underwriting profits and investment income and retain those earnings on the balance sheet instead of paying them out as dividends. This slow, disciplined compounding is the hallmark of a great business. The second way is the dangerous way. If they want to grow faster than their internal profits allow, they have to go out into the market and raise expensive outside capital by issuing new stock or taking on debt. This dilutes the existing shareholders and destroys the magic of the compounding machine. The greatest insurance franchises in the world respect the regulatory ceiling. They prioritize strict underwriting discipline over rapid growth, ensuring their surplus capital is always strong enough to survive a crisis. And this constant industry-wide battle between the desire to grow and the need for capital creates wild, violent swings in the entire insurance market.
Those violent swings are called underwriting cycles. Next time, we are going to explore why perfectly good companies suddenly start losing money when the market enters a soft cycle, and how massive natural disasters can instantly wipe out capital to create a highly profitable hard market. That is exactly what we are going to uncover together here at Start with the A's. We are breaking down the market one industry at a time, applying the Buffett method to separate the true compounders from the value traps. Hit that subscribe button, and I'll see you next time.